Namaskar, good evening, hola, marhaba, bonjour. I'd like to welcome you all to this live webinar by Pace 360. We are indeed grateful to all of you for taking out your precious time to attend this webinar. My name is Kanika Miglani and I'm the Head of Marketing and Client Relations at Pace 360. And today I have with me Mr. Amit Goel, who is the co-founder and Chief Global Strategist at Pace 360. He co-founded Pace Group in 1995 and has focused his energies on researching global asset classes and financial markets since then. He has been keenly involved in advising large corporate houses and family offices on their asset allocation strategies. His articles and newsletters on financial markets and spirituality are very well known. Amit is also a familiar figure on TV, where he has appeared on various business channels for his views on global financial markets. With the global spread of COVID-19, we find ourselves in an unprecedented situation for the global economy and the global financial markets. Today, we will talk about the unique opportunities and challenges in this current volatile global financial landscape. We will also talk about the strategies that investors can adopt to navigate through a very uncertain future scenario. We are glad to have your participation in this webinar. To make the session interactive, we shall open the question and answer session right after the presentation of Amit. So continue to post your questions to us. To send a question, please use the Q&A panel, which is on the bottom side of your screen. Just type the question, your name, location, and click on the submit button to share your question with us. Now I'll hand over the session to Amit for the presentation.
Thank you, Kanika. On behalf of Pace 360, I welcome all our participants from different parts of the world. It is indeed a great opportunity for us to be able to connect with you and to be able to share knowledge and consciousness with you. We also hope that all of you are safe and doing well in this age of COVID-19. So in order to really understand and appreciate where we might be heading in the financial markets and in the global economy, it is important for us to understand and appreciate what all has happened in the last few months. This has truly been a historic period, both for the global economy and for the financial markets, and of course for all of us. So we will start where we left off in the last webinar, which was on 29th of January, just before this COVID-19 was sort of beginning to form its base in China and in other parts of the world. And we will start with the recommendations that we made from then, and then see how the markets have performed and what all has happened in the last 3 months. And then eventually we'll come to where probably we might be headed as far as the financial markets are concerned, and where we see potential challenges and opportunities for all of us. So I'll start off with the recommendations that we made in our last webinar. So we were extremely bearish on global equities, and particularly on US equities, because they had a stellar run up till that date, and we felt that the markets are extremely overpriced. They are rather priced to perfection, and any bad news, whether it comes from COVID-19 or from anywhere else in the world, the natural path for the markets would be to move down, the risk assets to move down and not to go up, because they were already priced to perfection by the time we had this webinar in January end. And this is what has happened. So S&P was hovering in the region of 3,200, 3,300 till then, and we made a peak at about 3,390 in mid of February. And you can see what kind of a cut we had. So S&P from a top of 3,390 approximately went down to about 2,200. This was the fastest ever correction in US equities in history. So from the bull market peak to the correction, which is defined as a 20% cut from the peak, this was the fastest ever. And in fact, we did not stop at 20%. We went all the way down to 35% below the tops. And this bottom was made, of course, in mid of March. So similarly, we were extremely bearish on emerging markets, because emerging markets in any case were not doing so well at that time. They were at an interim high, but they were not at a rally high. So the rally high of the last few years was made in January of 2018, when the emerging markets index peaked out at 52. It was about 45, 46 in January, February, and it went all the way down to 30. So this was a cut of about 35%, which was again the sharpest ever fall in emerging markets in a matter of 5 to 6 weeks. So all this just helps us to understand how unprecedented this period has been, and how abnormal or supernormal, whatever you may wish to call it, this entire period has been. And this would help us to appreciate where we might be headed in the near term and in the long term. So we were extremely bearish on emerging market currencies as well. We thought that the carry trade had been continuing for a very long time. And we felt that emerging market assets are not going to hold. So both emerging market equities and emerging market currencies are going to slide, because again, this was just a sign of too much irrational exuberance in the market. And this is how it panned out. So from a peak of in the emerging market currency index, from a peak of about 1670, we went all the way down to 1546 just within a matter of 5 weeks. This was again absolutely a change of unprecedented magnitude in a very, very short span of time, thanks to COVID-19. US Treasuries, this was one of our very, very high conviction calls, and US 10-year bond yields were hovering in the region of about 1.65% at that time. And we felt that US Treasury yields are going to go down a lot. So we felt that US 10-year yields are probably going to go down to 0.6, 0.7, which is a cut of about 60%. And similarly, US 30-year bond yields are going to move all the way down from 2.15 to less than 1%. And here we were at loggerheads with some of the top financial market and some of the top hedge fund experts and titans in the world. For example, people like Jeffrey Gundlach and Ray Dalio, who felt that the US 10-year bond yields and 30-year bond yields are probably close to their bottom, and they are actually going to go up and not go down. So Jeffrey Gundlach, who's called the bond market king for whatever he has done in the last few years, he felt that US 10-year bond yields are headed from 1.65 to about 2.05%. But we were absolutely categorical that the only way US 10-year bond yield is headed is down. And look at the kind of cut that we had in US 10-year bond yield from about 1.65% in end of January. We went all the way down to 0.31, which is absolutely unprecedented. This was the lowest ever US 10-year bond yield. And the fashion in which this happened in such a rapid period of time, and the kind of moves that we saw in this market, they were so massive and so unprecedented. So even the bond market bulls, people like us, were taken by surprise by the sheer ferocity of this down move. And then, of course, once they bottomed out, they even sharply went up, but nowhere close to the level of 1.65 that they were in January end. We have been extremely bullish on gold for quite some time now. So I remember that way back in May 2019, we had sent this recommendation and a message to all our clients globally that this is probably the last window that you have to buy gold at lower prices. And at that time, US gold prices in terms of dollars per ounce was as low as about 1280. Today it is hovering around 1730. And we felt that this was the last time that you could buy gold at lower prices. And similarly, when we were doing the last webinar, we maintained this long bias. We maintained this extremely bullish call on gold. And look at what gold has done. From a level of about 1500 odd, we went all the way up to 1780. But of course, before we did that, in March, when there was a flight towards US dollar and people were just selling all their assets in panic and going towards US dollar to be able to pay their obligations and their liabilities. That time it did go down to about 1450 to 60 odd. But overall, if you look at gold, it has been on an upward trajectory now for more than a year. And we believe that this long-term trend is probably going to continue. There would be a few corrections here and there, but the long-term path on gold is clearly headed up. Last but not the least, we had made this prediction last time in our webinar that two currencies of the world which were largely pegged to US dollar by their respective governments. One was one was Nigerian naira, and the other one was Lebanese pound. We were of the opinion that these two currencies are probably the governments and the bank and their central banks would not be able to hold on to the pegs, and they are headed for wholesale devaluation. And this was a very bold call, because Lebanese pound has been in a peg now for many years, and even Nigerian naira was at that time in a pretty strongly held peg, and nobody thought that that peg could break in the near future. But this is exactly what happened. So there was a huge devaluation in Nigerian naira in about the last week or last 10 days of March. And this was of the magnitude of about 20%. And in the parallel market, which is the gray market, Nigerian naira is even now at a US dollar is quoting at 25% higher in the parallel market against Nigerian naira as it is as far as the peg is concerned. So there is a gap of 25% there, and we are absolutely of the opinion that even this current rate is probably unsustainable. It is not tenable, and the Nigerian government in near future, they may have to yet again resort to wholesale devaluation to bring their pegged currency in line with the market forces. Otherwise, the money would stop going into the country, because when people know that naira should be 25% lower, why would people inject or invest their money in Nigeria? So this is just a matter of time. This is going to happen probably over the next few weeks and a couple of months. Similarly, if you look at Lebanese pound, so Lebanese economy is imploding. They are already in the process of defaulting and restructuring their debt obligations. There is no way that they can repay their dollar and euro bonds anytime soon, because the foreign inflows have dropped to a trickle, and their liabilities are so huge that it is nearly impossible for them to meet up their liabilities. And this is what has happened to the peg. So while officially they still maintain the peg, but in the unofficial market, Lebanese pound is trading at 250%. So dollar is trading at 250% higher against Lebanese pound in the parallel market. So from rather than a rate of 1511 that the government would make you to believe, the actual rate is more than 4,000. So you can very well imagine that this is also a peg which is for all practical purposes, it has been destroyed. And it is only that the government would finally succumb, and over the next few weeks, they would probably have to bow down to the market forces and accept the new realities. It is only then that the foreign investors and Lebanese people who send remittances back to the country, it is only then that they would start sending money back into their home country. There is no point sending your dollars to Lebanon at 1511 when the actual rate should be more than 4,000 Lebanese pound to a dollar. So this is how things have moved in the last 3 months. And we would also at this point of time want to cover some of the other very stunning and spectacular moves which would help you to understand and appreciate how abnormal this last few months period has been, and what is the kind of challenge that people who are investing and trading in this market, the kind of challenges that they have been exposed to. And this would also eventually help us to appreciate where we might be headed. So this is by far the craziest thing that has happened in the last few months. So WTI crude, which was in, let's say, February, trading at about 45, $50, it went all the way down to minus $40 in April. So this is absolutely unprecedented. It has never happened before that any commodity in the world has actually traded at negative prices, and that too a huge commodity like crude. So WTI is one of the most important indices of crude. The other one is Brent. And not only did WTI on the US exchanges go down in negative territory, there were actually many parts of the US crude oil market, particularly in the landlocked areas, where the crude oil prices went down to minus $50 and beyond. So what it means is that the producers were, rather than selling their commodity for a consideration, they were trying to get rid of their commodity produced by them. They were trying to sell them at huge negative rates because they had no place to store that crude oil. So this is something which nobody in this world could have imagined. And this is obviously a result of the huge destruction in the crude oil demand because of the fact that the transportation and the global economy came to a screeching halt between March and April. So basically, you can just imagine the kind of pain which the crude oil producers and the traders who were holding on to their long positions would have suffered because of this move. And even now, while WTI is trading at about $16, $17, there are many there are many different versions of crude which are indexed to WTI, which are trading very, very close to zero levels. So this is something which would just help you to understand how just how abnormal this entire period has been for all of us and for all of you. So this is another very, very stunning chart that I would like to point your attention to. So CBOE VIX, which is the volatility index on S&P 500, which was hovering around 12 or 13 in February, it went all the way up to its all-time high ever. So it closed at about 83 at its, at the market's worst point in March. This is the all-time high closing for the US S&P volatility index. You can just appreciate the kind of nervousness that was there in the market. S&P was below 2200. The bulls were running helter-skelter. There was complete panic in the market, and the options were priced so high. So it appeared to many in the markets that this market is probably going to go down all the way to zero. So if crude oil can go down to negative, why can't S&P go down to from 2200 levels to 1500 or even 1000? So that's the kind of crazy period this was. But of course, there was also an opportunity here, and this was around the period in mid-March when we turned bullish. So we reversed our bearish calls, which we had continued right from December end to February. And we not only reversed our bearish calls on S&P and on the other global equity indices, we actually some point in March, we went long in those indices because we felt that the central banks and the governments of the world would probably put a backstop, and they would not allow this economy and this capitalistic system to just suddenly go belly up in just a matter of days. And of course, in hindsight, I can safely say that that call turned out rather well for us. So this is this is again a historic sell-off. It just shows what kind of sell-off did you see in some of the risk assets. So from 1673, we went all the way down to 1488 in this equity index, and now of course things then recovered completely. Yeah. So this is just a second. Yeah. So this is a stunning move in gold that we saw in March and April of this year, when the so what you can see here is the price differential between gold futures and gold spot, and this went up to almost $70 in March. This is absolutely at an all-time high, and this happened because the physical most of the physical gold was not lying in US, and the gold futures, they belong to the US exchanges. So there was, because of the fact that the US and the logistical chains had broken down in the world, there was no way for the gold to have moved from other parts of the world into US. This differential went up to $70. Since then, this differential has subsided as the global economy is limping back to normal. But the fact of the matter is that this was a very, very abnormal move that had happened that time. Yeah. So I wanted to point out your attention to uranium futures. So uranium was one of the very, very few commodities that actually went up in the March to April period. So you would see that uranium was largely range bound in January, February, and March. It just went down a little in March, but then it went up by almost close to 50%. So the reason why probably this happened in uranium was that the supply chains were broken, and unlike other commodities of the world where the demand was also broken, uranium is largely used in the nuclear power plants in the world. And if you cannot allow the uranium power plant to not get its uranium supply, you have to keep the power plant running at all times. And because of this, there was suddenly a shortage of uranium that was felt by some of these power plants. And to be able to recoup their supply, they had to pay a substantial premium. And so this is probably the only commodity that I can think of which actually, even in that panic period when people were selling every asset class, they were selling equities, they were selling currencies, they were selling commodities, they were selling bonds to get themselves into US dollar to be able to pay their liabilities and obligations. So this was probably the only exception where the commodity actually went up because there was no let up in demand. On the other hand, the supply chains were broken. So we've covered some of the very, very stunning moves. We also want to cover some other remarkable moves, which would also help you to appreciate what happened around this time. So some of the emerging market currencies, they simply collapsed between March and April. So between the top points of this year, currencies like Mexican peso, South African rand, and Brazilian real, these currencies depreciated by anything from 35 to 42% from their best points of this year to their worst points in April. Now, these are all rather large countries, and these are all relatively better off countries within the emerging landscape. These are not the smallest of countries or the, let's say, some of the banana republics in Africa or South America. These are very, very respectable countries and financial markets which are followed and tracked by a large number of analysts and traders and fund managers like us. And they went down by something like 35 to 40%. You can just imagine the kind of pain people who were long on these currencies or who were short on dollar, they would have experienced around this time. So a currency like South African rand went up from, again, I mean, dollar went up from 14.63 to as high as 19.30. Mexican from 18.5 went all the way down to 25.5, and Brazilian real from about 4, it went all the way to 5.74 a few days back. So these kind of currency shifts and this kind of depreciation, not in one currency, but so many different consequential emerging market currencies, is absolutely, again, unprecedented in history. So this is the Brazilian equities in dollar terms. And we wanted to showcase this to you because, again, Brazil was one of the top performing equity markets of the world in the year 2019. And nobody could have expected that this year would, without any substantial bad news that we have come across as far as Brazil is concerned, from being the top performing equity market in the world, it became the worst performing equity market in the world in this year 2020. So the ETF, so the Brazilian MSCI ETF, which is a combination of exposure on equities and Brazilian currency, this went down from 48.36 to less than 21 in a matter of 3 months. So this was basically a move of about 55%. Imagine Brazil is a country of more than 100 million, more than 200 million population. It's a very large economy. It's among the top 12 economies of the world in terms of size. And this is the kind of destruction which happened in Brazilian equities in just a matter of 2.5 months. You can imagine anybody who was sitting long unhedged on Brazilian equities, what kind of panic they would have experienced in the middle of March, all this while when this huge cut was happening. So while this destruction was going on, there were just a few stocks which actually got the better end of markets treatment this entire March, and in fact some of them have actually gone on to make higher highs in April. So some of these stocks, and you can obviously guess the names, so these are the internet economy stocks. The internet economy, as you can largely imagine, has done a lot better than the brick and mortar economy, because some part of the action of brick and mortar economy has actually gone into internet economy. We are all sitting at home. We are all using net and media and electronic media a lot more than what we were using till, let's say, February. So obviously these stocks are all belonging to the internet economy. So Amazon, from 2,178 high in February, has actually made a high at 2,460 in April. Netflix also made a higher high by about 15%. Zoom has actually zoomed from 105 to about $169. So that's a jump of about 60%. So just like uranium in the commodity space was an exception and it went up when everything else was going down, these are the exceptions in the stock market space, where these stocks have made new highs when many of the stocks are down to 10 or 20 or 30% of their levels in February. Rough rice. So this is again an indication of how very skewed this entire period has been. So rough rice, from a level of about less than $13, it has gone up to almost $17 in just the last 1.5 months. And this is obviously on account of the fact that rice is a staple and the consumption of rice has not gone down. Rather, there is an increasing trend towards vegetarianism, where some people are scared of some of the meat category, and some of the meat categories are not even readily available because of the supply chains problem. So the rice consumption, probably you can imagine, instead of going down, may have gone up, particularly in East Asia, where it is a staple and which has such huge percentage of the world population. So you can imagine that when all the other commodities are still very much down compared to their highs in February and March, rough rice is one commodity which is doing so very well. So now we come to some of the stunning moves in the economy. So we've covered some of the spectacular moves on the markets, and now we come to the stunning moves that we have seen in the broader economy. Most of them are extremely painful for us, but we would want to cover them so that we exactly understand the landscape before we move on to our recommendations and our strategies for future. So this is something which is absolutely unprecedented. So US unemployment was in the vicinity of 3.5, 3.6 at its best point in February. And from there, in just a matter of 6 to 7 weeks, US unemployment is now at more than 20%. So even during the Great Depression of 1930s, this move from the peak employment and lowest unemployment to the highest unemployment or unemployment of such magnitude, it did not happen. It took many years for this to happen during the Great Depression time. And this has happened in a flat 6 weeks this time. The weekly unemployment claims, which were hovering in the region of 200,000, now they have been higher than a few millions every week for the last 6 weeks, which is why the US unemployment, because to get to the US unemployment, you have to add the weekly unemployment data of the last 6 weeks, because we still do not have the official unemployment data for US for April. This we would get sometime next month. But this is simply unprecedented in human history. It has never ever happened before. So this tells you about this is how the governments have responded to this crisis of unimaginable magnitude. They have gone back to the printing presses and they are printing money like never before. So as far as the government debt and deficit in the world, we are basically taking US as an example, but you can very well imagine that the rest of the world is pretty much in the same boat. So we have gone back to practically where we were at the worst point after the Great Depression. So at the peak of the Second World War, US highest deficit of US economy was about 27% deficit to the GDP. This is expected to be more than 18% this year, as you can see in the black line. And the total amount of US debt from a level of about, it was absolutely the highest level ever, was 106% at the height of the Second World War. And this is expected to reach 107%. So US is going to be a more indebted country. US government is going to be more indebted than it was at the height of the Second World War. And I can tell you that even this figure of 107% is an underestimation, because what they have done is the US treasuries, which are held by the US government to cover their pension liabilities that will arise over the next many decades, that has been excluded from the figure of debt. If you add that, then I can assure you this debt figure is actually close to 120% or more and not less. So this just tells you how much money printing is happening, how much the governments would be indebted by the time COVID-19 crisis is over. So this tells you about the magnitude of the GDP cuts, and these figures came a few weeks back in light of what we've seen over the last few weeks, where COVID-19 figures, even though they have flattened out, but they have not gone down the way we were imagining till a few weeks back. So you can probably estimate that the eventual picture is going to be worse than this. So total world GDP this year is going to go down somewhere between 3.5 to 4%. My estimation is, and the estimation of our economic team is, that actually it's going to go down by more than 5%. To put that number in a context, the worst point in the last 70 years, where we had the sharpest global contraction in the global GDP, was less than 1%, which happened in the great financial crisis in 2008-9. This figure is going to be, as per IMF, this is going to be 4 times the worst figure in the last 70 years. And in our estimation, it's probably going to be 5 times or 6 times worse than the worst point of the last 70 years. So Federal Reserve balance sheet. So this is again an eye-popping trend that you can see. In 2008, the Federal Reserve balance sheet was less than $1 trillion, and then a lot of money printing happened after the great financial crisis and right up to 2012. And this figure went up from less than $1 trillion to about $4+ trillion. This figure has already, so we are just 2 months into this COVID-19 crisis, and this figure has already climbed to about $6.5 trillion. By the time we are finished with this crisis and the world economy really recovers, Federal Reserve balance sheet is probably going to expand to maybe something like 8, 9, or even $10 trillion. This is the kind of money printing that is happening in the world. And if US Fed is doing it, you can very well imagine almost the same thing to a larger or a smaller magnitude is being done in rest of the world. So the total amount of central bank reserves and the central bank balance sheet is expanding like never before in history. So after having gone through some of these stunning moves and what has happened in the last few months, we would now want to move on to the market outlook. And we would want to communicate as to where we are at the moment and where we believe we are going to be headed as far as financial markets are concerned over the next few months and for even longer term. So this is where we believe. So this is the chart on euro. So euro is a currency where we have been very bullish since the last few months. Particularly, we have turned extremely bullish since March, when euro hit its multi-year low against the dollar. We believe that over the next few years, euro as a currency is going to be headed up. There is literally very little downside in euro. And this currency, which is trading at about 1.0850 right now, we believe that over the next few years, it's probably going to all the way up to about 1.4, 1.5. So that's the kind of bullishness we expect in euro. And the reason is very simple. US has twin deficits. So the US fiscal deficit is extremely high, and it is higher than the Eurozone deficit, combined deficit. Eurozone countries are a lot more conservative when it comes to their purse strings than the US government is. US also has a huge current account deficit. US is the largest debtor country in the world. On the other hand, Eurozone is a net creditor to the world. These are two important reasons. Then the differential between the interest rates for Europe and US has gone down. There was a time when the differential of US interest rates were higher by more than 2.5% compared to Europe. And now that differential is just down to 0.6%. Similarly, we believe, if you look at the long-term cycles in euro and dollar, we believe that the long-term upcycle in dollar, which has gone on for about 9 years, is practically over, and the next 8 years probably would belong to euro. And this is also, last but not the least, the kind of money printing which is happening in US. We believe that the money printing in Eurozone will be a lot lesser than the money printing in US. So all these different indicators are suggesting that Euro is the currency of the future and we should be long Euro for the next few years. So, yeah. So these are the developed equities in the world. We believe that developed equities in the world, they've already come up quite a lot from their low point in March, but the long-term trajectory is still up in our opinion. We believe that S&P, Nasdaq, Eurostock 600, and similarly other developed countries, equity indices in the world, they are all headed higher. So we did give a buy signal in the middle of March because we felt that the kind of panic which we were seeing in the market, it was not just unprecedented, but probably a little uncalled for, considering that this pandemic is going to be over at some stage, considering that the governments and the central banks were doing their best to provide us a backstop, and considering that all people who were leveraged were forced to liquidate their positions at fire sale prices. So all these technical and macro indicators told us way back in March that we are probably bottoming out. There has been a huge rally in the last about 4 to 5 weeks. And you can say that most of the global indices have come up by about 25 to 30% from their low points in March. But we believe that the long-term trajectory is still up and not down. But of course, over the next few weeks, there would come a point where the markets may become extended, overextended in the medium term. So that would provide a great selling opportunity for somebody who's carrying the longs. But as of now, the medium term, long term indicators both are up. It is difficult to make a case that you buy at this point because we've already come up a long way. But this is a point where we can at least ride our existing longs and we sort of ride them over the next few weeks. We probably get out of them at a point, and we would get back to you when that happens, when we believe that we are hitting interim tops, and then we sort of wait for a correction and then climb back in, because the long-term trajectory in our opinion is still up and not down. So this is the emerging market equities equity index in the world. It's called EEM, MSCI Emerging Markets Index. So this has come up by about 20% from the bottom, but we remain very positive in this as well. We believe that there is still at least a 10% upside in the near term. And this would also probably get overextended in the weeks to come. But you can even buy right now because it's not extended right now and not so extended right now, and it has not come up as much as some of the developed market equities have. So we believe that there is a catching up to do as far as the emerging market equities are concerned. They have come up by 20%, but there is more way to go. So we recommend going long even at this juncture, and then we will let you know at a point where we believe that they become overextended in the medium term. That point is probably still a few weeks away. So this is the gold chart, and we believe that gold as an asset class is going to continue to do well. So as covered by me a few minutes back, we believe that gold is going to go all the way up to about $5,000 an ounce over the next few years. And this is going to make a new all-time high. We are just about 10% short of the all-time high right now. It is taking a breather right now because the focus of the world has gone into risk assets and not the safe haven assets. But if it corrects from here, on every downside, we recommend adding to your longs in gold and then sort of riding it for the next few years. We are not going to recommend even a short-term or a medium-term sell on this asset class, because we believe that the upsides are simply massive, and these upsides are probably going to pan out over the next few years. So basically, we come to the end of the presentation, and we've covered quite a few asset classes. And I know that I'm slightly running short of time, and I would want to cover as many questions as possible in the balanced time that is left for us. And so I now hand over the proceedings back to Kanika. I thank you for your patience and I thank you for bearing with us.
Thank you, Amit, for the insightful presentation. We are now open for the Q&A. So first question is by Mr. Omar from Dubai. And the question is, what is your outlook on gold miners?
Wow. Thank you so much for this question. Gold is obviously one of my favorite topics when it comes to investing. And I would love to cover all aspects that we possibly can on this. So I have a few slides on gold which I can share with you. So this is the total amount of gold production that is going to happen over the next few years. And you can see that right now we are probably at peak gold. We believe that the total amount of gold production is going to go down from next year, and it will probably fall by 40% because most of the gold which was, which had the scope to be mined easily has already been mined or is going to be mined over the next few years, and the total production, it will go down while the demand is only going to go up because there is so much of money printing which is happening in the world. And we believe that finally, because of this money printing, the money will flow to assets like gold because people would realize that so much of money printing would eventually lead to hyperinflation, even though we have deflation right now or disinflation. But so much of money printing will eventually lead to inflation and hyperinflation, and which is why gold is going to go up. So on one hand, demand is going to go up, and on the other side, supply is probably peaking out. So this is the reason why this is also a reason why we are so bullish on gold and consequently on gold miners. So if you look at the miners, you can see that miner equities are extremely volatile. In the recent contagion, in the recent crisis that you saw in the markets in March, you saw these ETFs going down by almost 40 to 50% in a matter of weeks, and they provided just a stunning value opportunity at that point of time, because while gold was down by about 15% from the peak, but gold was still up year on year, while the gold miners were available at the lowest prices in the last few years. So this was just an amazingly stunning opportunity. And these opportunities are, of course, difficult to come by, but it just tells you, it also sort of highlights the fact as to how much panic there was in the markets in the month of March, where literally baby was thrown with the bathwater and everything got sold out. So this chart tells you where gold miners are in the historical context vis-a-vis the price of gold. So eventually, the most important barometer for the gold miner equities is what is happening to gold, right? What is happening to the gold price. And if you see, in mid-90s, this NYSE index on gold miners, this was effectively trading at 0.5 to the gold price. And even in 2005 to 2009 period, the norm was that gold miner index was roughly at about 0.5 to 0.6 to the gold price. In the current context, it has gone down to 0.15. Of course, it went to even lower in 2015, but that was probably a complete anomaly, and you are not going to see that anytime soon or anytime in the next few years. So what we believe is that gold miners represent an amazing opportunity, and out of your allocations to gold as an asset class, probably at least 30% of that allocation can go to gold miners. because I would not say higher than that, because this is a very volatile asset. Unlike gold, which is not so volatile, this can easily move up by 100% and move down also by 40-50%. So this is not for the faint hearted. But if you have, in the overall portfolio context, a small portion of your portfolio in this asset class, over the long term, we believe this has to go a long way up. So we are extremely bullish on gold miners, and we would recommend that you should take advantage of any fall in either the gold price or the gold miner stocks or the global equity indices. If that induces a fall in gold miners, I think you should add to your holdings on every such fall. Thank you so much.
Thank you, Amit. Our next question is by Mr. William from London. And the question is it a good time to invest in crude oil ETFs like USO?
Wow. Thank you so much for asking this question, William. So this is what has happened. So USO is obviously a very important asset class in the scheme of commodity ETFs. And this has been our favorite ETF whenever we wanted to take a call on crude oil prices. But I want to show to you how much destruction has happened here. So this was trading at about $13 in January, and from there it has come down to 2.18. So this has fallen even more, much more than the WTI benchmark that you see in your computers. So if that has fallen by, let's say, about 65 to 70%, this has fallen by about 80%. And all this while we have kept away from USO. And I will also explain why we still continue to recommend not to participate in this EDFs, not to buy this ETF for the next few months. So here is my logic. So this is what this is the chart of WTI June futures and WTI July futures. Unlike what many of us feel, USO as an ETF, it does not buy actual physical crude oil and store it in its storage space. It does not do that. It actually buys WTI futures, and then it rolls over those futures every time the futures expire. And you can see here from this chart that the differential between the June and July futures is as high as $7. Now just appreciate the sheer magnitude of this. What that means is, if the USO ETF had its position today in June, and if it was transferring its position from June to July, it would have to pay a premium of $7. Now this is huge, right? So this is like almost 70% of the crude oil price itself. This is just your carry forward cost. So if we had storage space available with us, and if we had an option to buy, let's say, a particular crude in Africa or a particular crude in US at some dirt cheap price of $2 to $3 a barrel, and if we are able to hold it in our storage space, even after paying the cost of the storage, your cost is going to be next to nothing. And there is no way that you can lose out if you actually hold physical crude at a price of $2 to $3. But if you are holding US crude oil futures and you have to roll over your positions from 1 month to another, then after a few months, your cost of holding this crude may climb to as high as $30, $35, right? So rather than holding crude at $2 or $3, which the physical crude is trading at this juncture, your cost is going to be $35, something like 17 times the cost of physical crude at the moment. So there is a huge arbitrage opportunity available. So if I had storage space in crude available somewhere in the world, I would be buying crude closest to that storage space, and I would be selling USO against my physical crude holding rather than buying crude oil through the USO. So this is the reason why I'm neither going to buy USO nor I'm going to buy or recommend buying crude oil futures on the US exchanges. If you have access to physical space, you can buy crude oil and store it, and I can almost guarantee to you that over the next few months there would come a point where you would sell it at a very handsome profit. But this profit would not come to you if you are simply dabbling in the futures or buying the USO ETF. Thank you so much. Thank you, William.
Thank you, Amit. Our next question is by Mr. Ajitpal Bhatia from Delhi. His question is, do you advise any other overseas markets to invest across equities besides India and US?
Thanks, Ajit. Thank you so much for asking this question. So, this has been probably one of the biggest challenges that we faced in last few weeks, because while it is common to have a two-speed market, but a two-speed market of this magnitude, where some stocks like Zoom, Amazon, and some other internet economy stocks were making new all-time highs, while the others are languishing at 80% down compared to their prices of just 10 weeks back. So as a stock picker, I can assure you that there has never been, in history of capital markets, there has never been a more challenging time, because what is looking good is available so expensive, and what is not looking good is available at such dirt cheap prices that you get tempted to buy what is dirt cheap, and you get tempted to sell what is at trading at such an astronomical valuation. So this chart shows to you that in the last 12 years, the stronger balance sheet companies, so most of these growth companies, most of the FMCGs, the pharmas, and the internet economy stocks, most of these are strong balance sheet items because they do not need a lot of capital or a lot of debt to run their businesses. So the operating and the financial leverage of these entities is not so high, particularly the financial leverage. So you can appreciate that in the last 12 years, the strong balance sheet companies have never outperformed the weak ones as much as they have done recently. And this rise has been simply stunning and simply unfathomable for many of us who watch the markets on a daily basis. So, what we would understand from these markets is that while, yes, the growth companies, the large caps, and the strong balance sheet companies, they have done extremely well over the last few weeks, but now their rally has come to a point where, and they have now come up so much that some of them are beginning to look overextended. So probably if any of us, if we are riding onto these internet economy stocks of these FMCG and pharma stocks, which are relatively insulated from the current problem, it is probably a time to relook at your portfolio. And this particular chart exactly tells you that this is probably a good time to do it, because in the last few days, you can see that the equal weighted S&P has done better than the market cap weighted S&P, which means that in the market cap weighted S&P, obviously you would buy mostly the large cap stocks like Apple, like Amazon, like Microsoft, but in equal weighted, you would buy them as much as you would buy a stock which is, let's say, a shipping or an airline stock which is in S&P 500. You would buy them in exactly the same proportion. So this equal weighted index has actually started outperforming in the last few days. And we genuinely believe that over the next few weeks, as this market goes from oversold to overbought, there is a chance that some of these smaller caps, some of these weaker balance sheet names, some of these cyclical names will tend to outperform. And once the markets as a whole become overextended, we can probably book our profits in all of these stocks. But probably as a trading bet, it may not be a bad idea to bet on these stocks for the next few weeks and even for long term, because eventually this COVID-19 problem is going to go away. So eventually we are pretty optimistic that some of these weaker balance sheet and these cyclical stocks will do very well. But even in the near term, they are expected to outperform the stocks which have already done so well and which have already climbed so much. So probably it's time to do a switch between them. Thank you so much for asking me this question, Ajit.
Thank you, Amit. Our next question is by Mr. Jonas from Germany. And the question is, will COVID-19 have a big impact on the financial markets going forward?
Thank you so much, Jonas. So this is obviously a very important question in the current context. So while we have tried to address it briefly during our presentation, but probably your question gives me an opportunity to sort of deliberate more on it. So this is the chart which shows you the trend of COVID-19 infections in different countries of the world. And as you can see from this chart, in most of the countries, we are now seeing flattening of the curve. So initially, people thought that the flattening in many of the parts. So in China, of course, China was the first one to flatten out. They flattened out sometime in February end and March beginning. And from there, we started getting maximum number of cases in Europe and in Iran. So we are now definitely seeing a flattening in European countries, particularly Italy and Spain. And after that, it went to UK, and in the last, it came to US and South America. So we are of the opinion that even in US, we are now seeing a flattening out. And South America, which will be the last one to flatten out, we will see flattening over the next few days and probably a week or next 10 days. So this is a very important signal that probably the worst of the panic is behind us. And because of the fact that the curve is flattening out, the governments of the world would feel encouraged, or they would feel motivated to start reopening their economies. So when you start reopening their economies, then obviously your economy would start working a little more normally. And over a period of time, we believe that things will be better than where they are at the moment. Right now, the contraction in the economy on a year-on-year basis is something to the tune of 40 to 50%. This is obviously going to go down as summer approaches and as the infections flatten out and as we open up. But apart from that, some of the top companies and some of the top institutions, some of the top universities, and many of the governments in the world are right now working day and night on a possible cure for COVID-19 and also on a possible vaccination. So if you talk about vaccination, in some cases, the vaccination, for example, in Ebola, it took us almost 5 to 6 years to come up with a vaccine. And even that was considered an achievement. But it is very assuring for us to now hear from the governments and from some of the companies which are involved in some of the universities like Oxford, which are working on this. It is highly encouraging to understand that the vaccination is probably going to come maybe in September or October, and it will be available on a wholesale basis, and it will be available for everybody. I'm hopeful it will be available by next year, April or May. And you would be happy to know that there is this project which has been conceived by the US government, which is called Time Warp, where they plan to get together these 70 or 80 different institutions in the world who are developing this vaccine. They want them to come on a same platform, and rather than duplicating the efforts, take advantage of the fact that some are ahead in the curve and some are not so ahead in the curve. Take advantage of that and do this on literally a war scale to make this vaccination available on for the masses as early as December of this year. And I'm very, very hopeful that between December of 2020 and April of 2021, this vaccination is going to be available on a mass basis. This is absolutely a great news. Next point, if you have been tracking Gilead Sciences, which have this tablet called Remdesivir, which has been used in some of the other coronaviruses before, and which has worked in some of them. In trials, it is showing that it is, especially if it is administered early on in the infection life cycle, it seems to be working. So and probably this thing will get further established as more clinical trials happen. So between this possible cure, at least in the early stages, between the flattening of the curve and the developments on the vaccination, we are very, very hopeful that COVID-19 is not going to be with us for a very long time. We are an optimist, and we believe that that one of the main reasons why we have seen the markets react the way they do, the way the markets have rallied, risk assets have rallied in the last few weeks, it is largely because the market, in its wisdom, it does understand that this is a temporary phenomenon. This will not be with us for many years. Of course, some effects may last longer than some of the others, but overall, the worst is probably behind us, or we are experiencing the worst right now. And as we go forward, because of the reopening of the economies, because of the flattening of the curve, because of the potential treatment, and because of a potential vaccination, the long-term trajectory of the markets is up and long-term trajectory of COVID-19 is down. So this is where we believe we stand at the moment. I'm grateful to you, Jonas, for asking me this question. I did want to deliberate more on this, and thank you for giving me this opportunity.
Thank you, Amit. Our next question is by Mr. Jeffrey from New York. And the question is, will we ever witness hyperinflation in US and in the rest of the world? If yes, then how far that time is?
Wow. Thank you so much, Jeffrey. So as you can see, the printing presses are on. And just in a matter of last 2 months, you can see that the amount of cash in circulation in US has gone up quite a lot. So in 1 month, it has gone up by 1 trillion. And this is going up every passing day. So the total amount of debt which the governments are issuing is right now at an all-time high. The total cumulative debt is also at an all-time high, and it is going to go higher. The total amount of money in circulation is also at an all-time high and getting higher. The total amount of debt, public, private, and household debt in the world is also ramping up very, very fast. So this debt was less than 100 trillion in 2008-9 when the financial crisis happened. And this is now probably closing on $300 trillion. So we are of the opinion that this amount of money which is being unleashed in the system, this is never going to be taken back. So it is very easy it is like steroids. It is easy to get onto steroids or to drugs, but it is very difficult to get yourself to be off steroids. Similarly, this injection of money is like steroid. And we saw even in 2012 to 2018, when US started going back on the amount of on the US Federal Reserve balance sheet size and on their total size of the reserves on the balance sheet, it took them many, many years to remove a fraction of what had been added just in a matter of 3 years between 2009 to 2012. And before they could complete even 30% of that fresh money printing has happened, and US balance sheet, US Federal Reserve's balance sheet is now expanding at the fastest possible speed. So we believe that with all this money being printed, and this money is going to be, it will going to be continue to be printed over time. Once this COVID-19 crisis will probably be over, some of it will go back, but then the next crisis will come somewhere down the line, because we are very in the late stages of this economic cycle, and again there would be more money printing that will happen. So this tells us that hyperinflation is almost a near certainty as far as we are concerned, and this is what we believe. So we exactly don't know when this hyperinflation will happen. Right now we are in a disinflation period. It is possible that this disinflation period continues for another couple of years, and from then we start facing higher inflation, and then eventually we'll face hyperinflation, because of which the currency values will get depreciated against gold, against food, and against most of the real assets in the world. So which is again one of the reasons why we are so bullish on gold. Gold is one of the very few assets which does well in disinflation, does well in deflation, and does extremely well in hyperinflation. So this is why we are long-term bullish on gold, and in our opinion, the long-term hyperinflation in US and in every other country and every other economy of the world is nearly a certainty. We could debate on when it's going to happen. It may happen in 2 years, it may happen in 5 years, but it is going to happen. Thank you so much, Jeffrey. Thank you for asking this question.
Thank you, Amit. The next question is by Mr. Sudeep Raj Singh from Delhi. And the question is, how should an investor decide the duration or maturity of the bonds for his portfolio?
Right. Thank you so much, Sudeep. So this is, of course, so just like it has been very difficult to decide the right stocks between the strong balance sheet ones available at a very high price and the weak balance sheet ones available at a very low price. Similarly, it is for us bond fund managers, it is very difficult for us to decide which part of the yield curve is going to give us the maximum returns and least volatility over a period of time. So I wanted to showcase this example to you of South Africa and Brazil, where in South Africa, for example, the difference between the short-term and the 10-year bond yield is as high as 7%. So the long-term bond yields are almost 3 times the level of the short-term yields. And in Brazil, this difference is almost about 1.5, it is about 2.5 times of the short-term yield. So this decision is probably easier made in the context of South Africa and Brazil, where we can probably see a lot of value in the longer end of the curve, where we are getting a very good yield, and also in the context that foreign investors have been sellers of bonds in these currencies. And as carry trade comes back up again, which eventually it always does, after this horrendous phase of last 2 to 3 months, carry trade is going to come back. Carry trade would coming back would mean that foreign investors are going to invest in the emerging currencies, and they're also going to invest in the emerging debt, and they are also going to invest in the long-term debt. So rather than being sellers in these asset categories, they are going to be buyers in these asset categories. So what that means is that we are very bullish on South African and Brazilian 10-year bonds. This decision of deciding between short-term and long-term is a lot more difficult in Europe, for example. In Eurozone, the short-term interest rates are, let's say, 0.6, and your German 10-year bond yields are at minus 0.47. So it is a very difficult decision. So we as fund managers dislike negative yields, as I'm sure most of you do. So this decision, if we need to take this decision in Germany, for example, it would be a very, very difficult decision at this point of time. So probably I would rather be in short term than to be paying minus 0.47% to be having the luxury of holding the German government debt for 10 years. So we are of the opinion that in most of the emerging countries, this is a great opportunity in whether it is Brazil or South Africa or Indonesia or even Mexico. It is a great opportunity to get into the long end of the yield curve and not be on the short end of the yield curve. And we believe that you are going to get gains from the currencies and you are going to get gains from the appreciation of these bonds as well. Even in India, for example, the short-term rates are about 4.5%, and the 10-year government bond yield is about 6.1, 6.15. This is also not a bad spread between short-term and long-term. And even in India, I think it is probably a good decision to take. But in the developed world, I would be very scared of taking a call on US 10-year bond yields in US or in Eurozone or in Japan, because I just do not see any depreciation in the bond yields or any appreciation in the bond prices. So in developed markets, we would probably be at the lower end of the curve, at the shorter end of the curve, and in most of the emerging economies, we would be on the longer end of the curve. Thank you so much for asking this question.
Thank you, Amit, and all my dear participants for this interactive Q&A session. For the participants whose questions couldn't be answered due to paucity of time, please be rest assured and our best of the responses should be wired into your respective inboxes. We'll be glad to have your valuable feedback for our future action and improvement. To share your feedback with us, please use the Q&A panel, which has the feedback link. Just click on this feedback link, fill up the feedback questionnaire, type your name, location, and click on the submit button to share your question with us. That brings us to the end. I sincerely appreciate your time and attention for joining us from different parts of the world and making this webinar a success. We truly appreciate your continued support. We shall look forward to your participation in our upcoming webinars as well. We shall keep you posted. Thank you and have a nice day ahead.
Thank you so much, everybody.